Hello and welcome to another episode of Mentor Musings. As always, I'm JC and I'm joined by my co-host Brett. Hey, Brett.
Hey, good morning, JC. How are you today?
Doing great. Happy Friday. Another great week mentoring startups and founders. And I know we've got a lot of interesting stuff to talk about. So why don't we dive right in? Brett, I'll ask you, what was on your radar this week? As you were mentoring and guiding founders, what popped up? What interested you?
Yeah, there's always lots of good stuff, and you just never know where the week's going to take you. But the one thing, that kind of surprised me this week, and I'd love to get your take on it, is I was reading an article about VC-backed companies, and a stat that jumped out to me was, less than 7% of the Inc. 5,000, not the 500, Inc. 5,000, were 6.5% were VC backed and another 7.5% were angel backed. So, basically less than 15% of those companies had what call it formal funding. So everything else is family and friends. And that just really surprised me. I don't know, for some reason, I thought that number would be a lot higher. So I'm just interested in your take. Try not to surprise you too much, but I'm just interested. Does that number surprise you?
Yeah, I mean, it does. I think, especially because founders, we all in the startup world place such an emphasis on capitalization, and I think what we're talking about is fundraising, which is a vein of capitalization. So if I think about it, I'm not surprised, but immediately my reaction is yes, because fundraising is so important, but capitalization, like you were referencing, can take on such a bigger and broader perspective, whether you're talking about friends and family, you're talking about debt-based financing, plus eventually if you're able to get, kind of a sufficient MRR, ARR off the ground, especially in B2B, you can do things like venture debt, which I don't think probably technically classifies or categorizes as venture-backed, venture capital. It's just venture debt. So no, I'm not surprised by that in the sense that if you think about fundraising in a broader perspective, but because we all talk about fundraising and talk about this importance of angels and VCs and just the stress that it causes, it's disproportionate relative to the impact it has on the early stage founders' decisions. So that's surprising.
Yeah, no, that's a good point. I was actually encouraged, to be honest with you, right? Because I'm a big believer in, self-funded, bootstrap as long as you can. And if you can grow out of profits, even better. It's just you control more of the company for a longer period of time. And I get there's opportunities and times when you need to scale or make those investments and you need it. But the longer that you can, this is my opinion, I'd love to get your take, the longer you can hold out and self-fund, the better off in the long run that you're going to be. Obviously, strategic decisions can impact that, but I think there's just to your point, so much chatter in the press or in research, and maybe not in the research, but everybody talks about the funding as a milestone versus maybe the outcome of the actual growing your business.
Yeah, no, I completely agree, Brett. I would say founders in general, especially first-time founders, they create this false equivalency where if you fundraise, you're successful. And that is only a very small part of the pathway. In fact, I know in my world, some of the best exits that we've ever seen or been a part of in one form or another have been companies that never externally capitalize. Now, that is exceedingly rare. But I do think a lot of founders, again, they think, okay, my goal in starting this venture is to fundraise. No, fundraising is a means to the end goal. So no, I definitely think it hopefully that stat, and we should shout that from the rooftops and blast it all over social, and everybody who's listening, share that stat that less than 15% of the Inc. 5,000 companies were VC or angel backed. And that's not because VC and angels aren't great investors. I think it's just because people are being creative and thinking about capitalization more broadly than fundraising.
Yeah, and I think it even comes down to maybe some of the younger founders, right, that haven't been through the process before. And, it seems to be that you've made it if you've, raised your Series A. And again, it's all situations are different. But again, I think my core message would be, man, it go as long as you can, right? Sustain, right? You don't necessarily be the 10-year overnight success. And there's ways, like I said, capital can help that. But man, keep control of your company as long as you can.
Yeah, dilution is so real. I mean, Brett, you've been an investor, advisor, consultant to so many startups. And I know, in my world, everybody who gets to the end of the journey, it's funny, successfully, a liquidation exit. Everybody exits. Right. It's the question of whether you're going right. Feet up or feet down, right? Everybody exits at some point, but if you're exiting from a liquidation standpoint, everybody gets that check. And I've literally done it with, you get an envelope and you flip it over and you start doing some math and you start thinking about the dead equity that you have in your cap table, maybe co-founders, partners, strategics that you gave, advisors, whatever you gave capital to, or maybe a slightly lower valuation or a bridge round than you would have liked. And what's amazing is when you start doing that kind of CEO back of the envelope math, how much dollars that actually translates to. And again, it's a good day because you're exiting and you're celebrating, and that's a major achievement. But there's still very real money and very real terms, not to mention how that's impacting your progression to that point. To your point, when you do take the venture track, there's a lot of opportunities that open up, and VCs and angels are great for offering guidance, support, and capital, but they are going to have a particular vision for your venture and expect you to kind of pursue that. Whereas you as a founder may have, ulterior plans or ulterior ideas. So I do think dilution is real, but dilution of strategy is also real.
Yeah, no, 100% right. I think maybe in a future episode, maybe we can dig deeper into some of the other financing options, as some of the debt financing is starting to become more popular, especially if you've got sustained and revenue, right? Sustained revenue growth, there's rev shares opportunities. So I think that would be a good full topic for us, and maybe we can pull someone in as part of that. But, as we look to, we're in early part of 2021, and this is episode 1 for us. I thought, I'd love to get your perspective on, and what are you looking forward to in 2021? Where is the startup world going, in B2B, not necessarily specifically. I know we both play a lot in that space. So just kind of curious. I had some conversations with some different venture capital firms this week just to get their take on, has things changed since the fall of 2020, and what are you looking at in 2021? And so maybe to kick it off, I'd love to get your kind of what's top of mind for you for this year.
Yeah, well, the first thing that I would look at in order to have a chance of semi-accurately predicting 2021, I think it's important that we look at 2020 and kind of the, kind of previously on, the last episode of Startup World. So number one, talking about fundraising, it's interesting. So looking at 2020, remember at the beginning of this pandemic, you had so much uncertainty, particularly in the capital markets. So VCs, angels, people who were funding new startups. And as a general rule, a lot of those organizations, they stopped deploying their capital to new ventures as actively because they weren't sure what extra capital they'd have to deploy to their existing investments. And so you can see that trend matriculate over 2020 because 2020 actually was a down year in terms of new startups funded from the previous year. So the amount of capital, and I can't remember the statistics, but we'll try to reference some of this in the comments for folks who are curious. But the level of capitalization from institutional finances for startups was down in 2020. But interestingly enough, the number of new businesses started were up. And it was actually up big. It was double from the year of 2019. And that's important, especially because 2019 had set the record for the number of new businesses started. So during a pandemic, you had two converging or diverging tracks. You had the level of venture capital and angel funds going into new businesses go down year over year. And you had the number of new businesses double year over year off of the already high year of 2019. And so I think 2021 is going to really drive and compel the intersection of those two opportunities. You have a massive amount of new businesses started because there's so much disruption happening because of COVID. And then on the tail end, you have all of this dry powder that's been sitting on the sidelines where VCs and angels are going to look to deploy and capitalize. So my big prediction for 2021 is I think we are going to hear at some point in the next 12 to 16 months the most startups ever funded. I mean, I don't know how that's not possible, barring some major exigent, macroeconomic circumstance that we all don't see coming. I think that's going to be the tailwind. Plus, you have one more thing, the level of exits that are happening right now. You have a lot of investors who, in addition to holding onto that capital, are now seeing significant returns from IPOs, crypto gains, other asset investment gains. And I think a lot of angels and a lot of VCs are going to be looking to rapidly deploy capital. I don't know. What do you think, Brett?
Yeah, no, I think you're right. And I think what's interesting now as we were exiting 2020, part of the pandemic is shifting things forever. And there's businesses that were kind of caught in the crosshairs, right? It was either a positive or a negative or TBD. Now I think we're far enough along, and especially if founders take a good hard look at their business, am I now positioned in the new economy or the new world order, because it's not going back. The distributed workforce is here, right? So if you're heavily involved in corporate, properties or office space, those days may be gone or different. I'm sure there's opportunities in there, but I think where I've been coaching more is to take a hard look, right? Is your business gaining because it was a short-term opportunity? Is this sustainable of where you're focused? And now is the time to take that inventory. And in the super, the super simplistic terms, is it a need to have or is it a nice to have business right now? And with the economy where it is, still the stock market's doing great, but overall the economy, you could say, is TBD where that's going. And in these uncertain times, I'm just a much bigger fan of need to have businesses than nice to have businesses. And I think one of my recommendations is always have that hard conversation. If you have a co-founder, if you have advisors, and say, if this is only a need to have, is there a way we can pivot to provide a greater level of service, or is there an opportunity to look at what we've created? So I know it's kind of broad, but I think, with a lot of that uncertainty, even though there is uncertainty, but I think there's more clarity now than what we had even 3 months ago. Does that make sense?
It does. Yeah. And I think the other thing is talking about resilience. Number one, if you've made it to this point with your venture, you've developed a significant amount of scar tissue, and that scar tissue is thicker skin. So, yeah. Celebrate and congratulate yourself, because it may seem like, kind of an innocuous sort of milestone, but this, at least in my professional career, is the most major market disturbance I've ever seen across the board, but especially for startups. But despite that, if you've made it this far, I think you're absolutely correct, Brett. It's a great piece of advice. Take inventory of what you have and where you're at, and also the longevity of the strategies that you're employing, right? Like, is this something that you are able to temporarily gain an advantage on? And that's okay. By the way, it's not admitting that is bad. Admitting that is particularly strong. It doesn't mean you should stop. It doesn't mean that you don't continue to pursue that advantage to its fullest extent, but it does mean that you need to be thinking about what that next big leg up and that big advantage is going to be. So that's where I agree. I think founders are thinking about what that next stage looks like, what resources, what materials, what advisors, mentors, what supporters and strategics do they need to be able to take that next step into what is TBD. So, just like anything else, everybody has an opinion on this. I think, Brett, not to speak for you, I think you and I are both particularly bullish in general terms, at least, of what startups are going to be doing in the future. And I think, and we've talked about this before, but I think we're on the precipice of another amazing 10-year run-up. And I think if we fast forward to the year 2030, 2031, I think we're going to be talking about how many life-changing businesses have been launched on the tail end of COVID, and how much life-changing amount of enterprise value and wealth has been created by those founders.
Yeah, no, I think you're right. Even going back to the point you made with the number of new startups that are being created, I think we're going to see more and more smaller niche, even if it's solo based, right? Everybody's going to become their own little company, their own little brand, their own little piece. And I think that was slowly happening, right? We talk about the gig economy, but that's been heavily focused on task type of things, right? Deliveries, home projects, those types of things. But I think as specialization occurs more and more, right? Your CRM folks that are super strong, or process people, or project management, companies will start to contract, right? I'm not sure if we used it with you, but, think of it as a movie, right? A movie set. You've got a bunch of different people coming together to create this film. And then when it's over, they go back their own ways and they look for their next project to work together. I 100% believe we're going to see more and more of that sooner rather than later, just based on where we are with the pandemic. With now people have been working from home for 12 months. They're not going back to the office, right? And how do you start to leverage yourself better? Is it, temporary in one company, or is it bigger? I know we're a little bit off topic here, but, I just really want people to think about the big picture, because I don't think this is an 18-month blip, then things are going to kind of get back to where they were. I think it's a wide open canvas for folks to think about this differently. And, it's about timing, but think bigger. There's going to be a lot of opportunities sooner rather than later.
Yeah, I completely agree. I think to your point, the settle point here is not where it once was. I mean, things will settle, but that new norm will be significantly different. And I think the marquee on the banner of the theater that's showing this new film I don't know what the title is going to be, but I think it's going to be different than anything we've ever watched before. So coming soon to a theater near you, a whole new world of startups. So Brett, any other final thoughts or comments for this week?
Yeah, just along those lines, I want to, again, I'm passionate about the B2B space, and I know the consumer, there's a lot of really good opportunities with people working at home, so direct consumer, healthcare. But within the B2B space, I'm liking this kind of inflection point we're at right now is when e-commerce finally went mainstream in the direct to consumer. I mean, it just fundamentally changed the way companies do business. There's still some big retailers that are struggling to figure out how to do that today, right? An example, I won't call it one of the major retailers, but they're now allowing shop from home, right? You shop and they'll send it from a store to your house. It's a major retail. They're using different shipping firms, right? So one's using FedEx, one's using UPS, the other one's using USPS. How does a brand that big not have a national contract to take care? So again, little thing, but it's going to create opportunity. So I think in the B2B space, we're at that point right now. There's some companies that are built in the old catalog days that are really struggling with how do we get into the digital. So bigger picture, think about, even if you weren't thinking B2B, but there may be some application for what you're thinking about in that space. And, over time, you'll hear this conversation on a weekly basis. It'll be a theme from me just because I just think there's so much disruption and opportunity right now. And there's so many smart founders out there that can help solve these problems. So I'll leave you with that on a Friday, but happy to go deeper. If anybody wants to reach out, I'm more than happy to share, kind of my thoughts in that area as well.
Absolutely. I tell everybody that we work with, despite the fact that I have experience in B2B, that Brett is the guy to talk to when it comes to strategizing your B2B plan. And I think one other thing that I'll wrap up with, especially in the B2B space, is that right now, because of the uncertainty of the market and the economy that you're talking about, you have a lot of very experienced, highly entrenched professionals who are now exploring entrepreneurship for the first time. Maybe they've lost their job, maybe their hours have been reduced, or maybe the prospect of their long-term career at the spot that they had before is no longer as strong as it once was. So not that we're encouraging anyone to quit a paying job or anything like that, but what we're recognizing is that a lot of folks who are entrenched in these industries, who maybe work at these large retailers, are seeing what we're seeing, and they're saying, hey, I think because of my background, this is the time for me to take a step. It's that asymmetric return, right? Your failure point was just as low as it was before, but your success point is much higher because everything's being turned upside down, and that settle point is different than it once was. So it's going to be an exciting time. Above all else, 2021 is going to keep us on our toes. Brett and I are going to continue to be here each week, maybe more frequently. We've got some more stuff coming up to mentor the startups we work with, to talk to all of you. Please, if you can, like, share, subscribe, reach out to us. Our email address is on the YouTube account. You can engage with us on LinkedIn or Twitter. We want to hear from you guys, and we're going to keep doing this as long as Brett and I keep finding it interesting and valuable. But hopefully some of you can tell us topics that you want to hear about or tell others about the platform. So with that, Brett, as always, great to muse with you, and look forward to chatting again next week.
Thanks, man. Happy Friday. Have a great weekend. Cheers, everybody. Talk to you next week.
Cheers, guys.